In this video, I'll be showing you the 3-bucket framework I use to organize every real estate tax strategy that exists, how the bucket works together to reduce, defer, or eliminate taxes across the life of a rental property, and how a high-income earner running all 3 can realistically save $25,000 a year or more that would otherwise go to the IRS. Through years of doing this work, I've discovered that high-income earners don't struggle with real estate tax strategies because they're a secret. Every strategy is public. They struggle because they've never been organized into a system. So they collect random tactics from random videos and never see how the pieces fit together. And that's exactly why I'm making this video today, to give you the whole map, every major real estate tax strategy into its own bucket, so you know exactly which tool does which job and in what order to use them. Okay, let's get right into it. Every legitimate tax strategy that's for real estate falls into one of these 3 buckets. It reduces your tax that you'd otherwise owe this year, or it defers tax into a future year, or it completely eliminates the tax permanently. Oftentimes the confusion online that you'll see is going to come from people mixing buckets with these different ideas and strategies. The buckets do have an order in general. Reduction strategies run every single year, deferral strategies are going to run at big moments, and elimination strategies are going to be really the end game and how you exit. Hopefully this framework is going to help you accomplish your goals better by really understanding where the different strategies fit in. Obviously the $25,000 illustration is just that. It's not a promise or a guarantee. Just the reduction bucket alone though, on an annual basis, if you do things appropriately, itself could be 5 figures in extra losses or deductions. The deferral strategies are going to arrive in big moments that we'll talk about, and it might not be an annual thing, but it could be if you continue on with the certain strategies. And I'll walk you through some math here in a little bit. So 3 buckets, 3 different jobs, 1 continuous system and framework. And the first one that we'll talk about is the reduction bucket. And again, these are going to work with you every single year. So the first one that really falls into this is just the straight line depreciation. This is obviously a non-cash expense that you're going to get, but I can tell you I've seen several times on new clients, they'll send me their prior year tax return or 2, and I will see that the depreciation was not taken, even just straight line, not talking about bonus depreciation, anything like that, just the straight line depreciation. And then maybe something that seems more common, but it is something that can be made sure is actually appreciated and expensed appropriately, is just the normal operating expenses like your mortgage interest, your property taxes, your insurance, management costs that you might have, utilities, just maybe some travel expenses, and maybe your home office. But you need to make sure that you get all of those pieces in there and make sure you actually deduct it. And that's something that I do see is if you have really sloppy bookkeeping, then you're not actually writing down, documenting the expense, then you're not going to be able to take it obviously on your tax return. There's no documentation for it. You're not even capturing it. Another piece would be the repairs versus improvements. Sometimes I'll see tax returns where a preparer just overcapitalized everything when in reality there should have been some of that should have been a repair expense and therefore deducted right then and there. Another piece would be just when you buy a property, one of the first things you need to do is determine the split between the building and land. And sometimes preparers will just take an 80-20 split. And maybe that's better off because in reality it should have been, 25% to the land and 75% to the building. And therefore they're actually getting you more deductions, but you're now taking on more risk. And it's kind of a rule of thumb approach which is not very defendable. But maybe you actually have a different situation where you should have taken 15% land and 85% to the building, and therefore you would have gotten more depreciation over the years. And again, this is really the annual bucket of just the reductions that you're allowed to take. There's nothing fancy here. This is just kind of the base hit stuff where you should be deducting all of your expenses, keeping track of it, making sure you're taking things that you're allowed to, like straight line depreciation, and just getting the normal things like repairs versus improvements correctly done. And so that's the every year bucket. The second bucket is going to be making a lot more headlines, getting a lot more attention online because it's the big moments, the big tax savings that everyone is looking for. And the main one is obviously cost segregation studies, especially with 100% bonus depreciation being back after the One Big Beautiful Bill came out in 2025. And that's allowing us to really accelerate depreciation from the future and now get it into the now. Another one would be a 1031 exchange where you're going to defer the actual gain on selling a property and you're going to kick the can down the road by having that deferral basically moving into the next property. And if you were to sell it in the future without a 1031 exchange, then that tax bill is going to come due. And just keep in mind that is deferring the gain, the capital gain, the appreciation, as well as the depreciation recapture. Both elements can get deferred in that example. This really, in terms of a 1031 exchange and cost segregation studies, is primarily a deferral in terms of a timing, and really that's what it is. It's a timing mechanism to really determine when do you want to capture those losses with the cost segregation study, or when do you want to capture the gain when you sell the property, right now or into the future, and you have these mechanisms to help you do so. But this is still really important because of the time value of money, where if you can get the losses today and then you can reinvest those dollars into something else that might compound at 7, 8, 9%, and you were to even have to pay that tax back because you sell and you don't do a 1031 exchange, then that growth you get to keep, right? Even though you might have to pay back the depreciation you took and accelerated, you still get to keep that growth for yourself. And this pairs really well with bracket planning. And what I mean by that is there's going to be years where you might have a high income because of RSUs are vesting, or you got a huge bonus, or you're changing jobs and you got a big bonus, something like that. And so you might have a big jump in certain years, or you sold a business, something like that, and you're going to have a big jump in your tax bracket. Well, we might be strategic in finding, well, how can we get losses today so that we can offset some of that at a higher bracket when in the future you know you're going to drop back down, or there might be this kind of ping pong version where you go up and down. And so timing those extra losses in years where you're going to have that higher income can be very strategic for you. And then and when you sell, you might be recapturing some of that depreciation that you took in the future at a lower tax bracket than when you took the loss in those high income tax years. And just keep in mind too, I'm kind of assuming that with this deferral of the cost segregation study, losses being moved forward, that you're going to use something like the short-term rental strategy or real estate professional status to make those non-passive losses to offset your W-2 or business profits. And just make sure if you've got some of this extra tax savings because we're doing this, don't just go spend the money, right? Reinvest it, make sure you're wise with it, and make sure that you're able to see some of that growth so that even if you need to pay that back in terms of the tax savings you got, which you could see as kind of a loan from the government, you're able to kind of show that, yes, we were able to grow that money faster than the depreciation recapture we had when we sold. Okay, quick pause here. If you're trying to figure out which buckets your situation can actually use this year, click the link below to book a call with me. I'll sort out with you your specific income and buckets and help you think through this framework specifically for you and really where the money might be for you. Now the third bucket, and it's the one that turns a tax strategy into a generational wealth strategy. So bucket 3, which is really the exit and the end game, is first and foremost something that's called the 1031 exchange or defer, die strategy. And this is thinking through the step up in basis rule. And this one's giant because even if you were to think through that you were going to sell a property, pay the full amount of tax just before the day that you passed away, and yes, this may seem like a morbid thing, but it's a reality, that you would have to pay a significant, sizable amount of tax, where if you had held it until you passed away, your heirs are going to get a step up in basis to the fair market value. So their basis is going to be the same as the fair market value on the date of your passing. So for example, let's say that you were going to pass away with $1 million fair market value property, but your basis was only $250,000. If you sold it the day before, you would pay tax on the $750,000 difference between the $1 million you sold it for and the $250,000 basis you have, okay? But if your heirs receive it and they get the step up in basis, well, their cost is not $250,000, which is what you had. Theirs is now $1 million, right? So now the fair market value and their basis is both $1 million. If they sold it as soon as they inherited it, they would pay zero tax. Okay, and so that's how that works, and that is a huge, very long horizon strategy that is not easy to pull off. It takes a lot of planning and a very disciplined approach. And really what we're typically doing, you could have just one property you hold for decades, that's very possible, or this could be something that you're continuing to do these 1031 exchanges year after year after year, hence the defer piece of this. But again, it's not something that's easy to do. It is a strategy and it does take a lot of planning to do so. You also have primary residence capital gain exclusion that right now we have a $500,000 capital gain exclusion we can get if you're married filing joint. So if you were to buy a property, your primary residence specifically, not thinking about rentals, everything we've talked about so far has been rentals up to this point. But if you were to buy your primary residence for say $250,000 and then you sold it, 10 years, 20 years later for $500,000, that $250,000 gain is completely excluded. You pay no tax, and that's permanent. That's not something that's deferred. It's not a reduction. That is a permanent strategy that you pay no tax on. And lastly, just with the opportunity zone investments that are now back in play and seem to be more permanent after the one big beautiful bill, you also have some permanency in terms of the capital gain that you're going to have not to pay if you do hold it for the long term over those 10 years. But I really don't see a lot of my clients in doing this strategy. It's very unique. You need to be comfortable with the asset and the investment in and of itself, which I talk about a lot. Don't let the tail wag the dog. So hopefully, as you understand some of these strategies in the end game and how it can permanently remove that tax bill, it's going to help you understand, should you sell the property or should you hold it? And this piece, especially in the end game type bucket that we're talking about for the permanent exclusion, this is also a big part of where you want to bring in your estate planning attorney and thinking through overall your estate and what's going to be potentially taxed as well. And as you probably are hearing, a lot of this is going to incentivize for you to hold, to buy and hold, and really not to sell. And that's what our tax system is going to reward. And once you understand how all three of these buckets interplay with each other, probably we'll stop asking the question of which strategy is best, because the answer will be that you run the first strategy, the reductions, on an annual basis. You deploy the second one when the timing is right, you've got large income, or you have the capital to do so, to get the cost segregation study, losses to offset your income. And then you aim the whole portfolio for the long game of hopefully you hold and don't officially sell. So that's kind of the full framework. Let me help you understand some of the realistic numbers here of how this could look. Let's pretend that you're a household earning $500,000 or more on an annual basis. You've got 2 long-term rentals and 1 short-term rental that you self-manage. Let's just say from your long-term rentals that you have, that is going to produce $25,000 of extra deductions from your 2 properties on an annual basis. And that is going to be just your annual reduction strategy. And then let's say that every other year you buy a short-term rental and you do a cost segregation study, but this year we just have the one. And again, let's say you've got your first one and you're going to do one of these every single year. And let's pretend that in the first year, that property is going to produce for you a $125,000 or $130,000 deduction via the net loss, because we've done a cost seg and we have met the short-term rental strategy to then use that to offset your W-2. So combined, we're looking at about $150,000 of deductions. Now, the $25,000 is just going to neutralize the potential profit that you have from the 2 long-term rentals. But the $125,000 loss from the short-term rental, that's something that you're going to see immediately in that year. And that alone is going to produce for you a $40,000 tax savings here in the first year. Now, if you're doing one of these on an annual or once every 2-year basis, you're going to get pretty darn close to that $25,000 a year of tax savings. Because every year, you're not only going to get that $25,000 deduction, and then you're going to have these bumps in your losses and deductions that you're going to get from the short-term rental that you're going to get, but also just from the short-term rental, it is also going to produce that 39-year property, which is also going to give you, call it $10,000 a year in deductions as well, just to neutralize some of that short-term rental income that you have. And again, averaging those across one couple of years is going to get you to roughly that $25,000 in tax savings on an annual basis. But keep in mind, there is depreciation recapture, as I've talked about in the past, and it is something that needs to be said and said again. But if you exit well through a 1031 exchange or a step up in basis in the future or a 1031 light, it is something that can be managed and neutralized if you execute well and you have a plan before you actually sell the property. And the strategy costs are real. You've got the study, you've got legal fees, you've got a CPA fee, you've got all these things that you need to do in order to execute this well. The biggest variable is execution. Everything that I've talked through assumes a lot of things and assumes that all of this goes well, it's documented well, you've done everything correctly. But if not documented well, if not executed appropriately, you're going to either put a lot of risk onto your tax return, and if you're audited, that's going to be a very difficult and frustrating experience for you. So these numbers can be real when the execution is real. Let's close this out with how to actually install this system and framework. Because a framework you watched is worth nothing until you run it onto your tax situation. So the first thing you need to do, in summary, is make sure you have a good, proper bookkeeping system in place so that you can capture all of the annual reduction strategies that we just walked through, just the typical straight line depreciation, the typical operating expenses. You need all of those to be categorized and captured appropriately with the right documentation, like keeping your receipts in a specific folder, whether that's a virtual or paper. And then you'll need to determine, are you able to meet with your household, the real estate professional status or the short-term rental strategy, to turn any losses you might generate to be non-passive? And that's really going to pull you into the second bucket, which is going to be the deferral, so that you can time the short-term rental strategy, for example, with a cost segregation study to get these huge bumps in your tax savings by doing the combination there. And hopefully you can either do the short-term rental strategy and a cost segregation study on an annual basis, if not every other year, to help you as you maybe are on an annual basis receiving that high income because you're in a high income job, that you can pull that off every single year. And then you won't really need these strategies as much, or they won't be as impactful if you have these other events or if you are to retire in a certain year coming up. But you want to have these strategies in play, and hopefully you're willing to put in the material participation time to see these huge tax savings in your high income tax years. And really, bucket 3 is, again, the long game. You may, if you do the step up in basis, obviously you will have significant tax savings, which is going to be generational. And you may obviously never see that because it's going to be when you pass away, but you are going to do your heirs a favor by doing that. Just make sure that you work with your estate planning attorney. Your heirs are well aware of what's the game plan and why you're doing it and what's at stake if we don't pull it off. One of the first moves you do after this is you go look at your last year's tax return to make sure everything that you see on your rental properties in terms of depreciation and your operating expenses has the categories that you would expect. Then it's thinking through, do you have the capital and the time and the ability and the appetite to go move forward with something like the short-term rental strategy and get a cost segregation study because you're in a year that has significantly high income? And then we put all of this in front of an actual professional, maybe me, but alongside another financial advisor, an attorney you're working with, an estate planning attorney, and we can bring this all together as a team surrounding you to make sure we're thinking through not only the short-term benefits, but also the long-term benefits. And the families, the households I see that implement this kind of system on an annual basis, stop really seeing tax season as just a bill they need to play, but more like a scorecard of how they've implemented these strategies themselves as a family. Okay, now you have the whole map. The reduction bucket that you're working every single year, the deferral bucket that you're deploying at significant income events, and the elimination bucket defines the end game, and some of the honest math that is going to connect this to real numbers. If you want your income and properties sorted into some of these buckets with actual numbers with your situation, click the link below to book a call with me, and I'll see you in the next video.